Hello, my name is Scott Green, and I'm the managing partner for the Green Law Group in Simi Valley, California. Today's webinar, Keeping Your Corporate Records in Order, is perhaps a bit dull, but nonetheless important. So let's scroll through a few pages here and get through the preliminaries. We've got some sponsors. These are folks that are good to know if you're in the construction industry. They can be very helpful for marketing and resources and lending in the case of Ventura County Credit Union. Here's my disclaimer. What you hear in the webinar today is general information, not designed to address anybody's particular factual situation. Where you have an issue of legal concern, the facts make a huge difference. So don't take my general information and go off and rely simply upon that. Get a specific legal recommendation from an experienced attorney based on your facts. Okay, Green Law Group. Basically, we're built for contractors. We handle all aspects of the law for contractors. In all honesty, property owners and others that might have disputes with contractors. So we know how it works on both sides. Here's our wonderful staff of attorneys, good looking folks all. So kind of the initial question regarding corporations that we hear a lot is whether somebody should incorporate to start with. And then if they should that be what's called C Corp, an S Corp, or a limited liability company? Let's start with the threshold question. Should you incorporate? When? Why? My general answer to that is when you have personal assets to protect from potential liabilities stemming from your business activities, you want to consider incorporating. What a corporation does, and LLC also does this, is it provides a shield to protect your personal assets from liabilities that may stem from your business. One of the unfortunate things I've seen in my long career was a case of a contractor who recorded a mechanics lien for a couple $100,000, I think. And sadly, the contractor's attorney did not file suit to foreclose the lien. The attorney lied to the contractor about having done that. The case went to trial, and the homeowners got a $200,000 plus judgment against the contractor for slander of title. They argued that the lien was invalid, should have been removed because it was never enforced by a lawsuit. They were correct. The contractor ended up now with this significant judgment. Contractor ended up going bankrupt. The bankruptcy court, however, kept the award intact because it was based on, in part, on fraud, arguments of fraud. And the contractor, who was, let's call him, he was in his senior years, lost his home because he owned his home free and clear. It was a beautiful home. And as a result of this bad outcome, he lost his home. Now, he was able to sue the lawyer. Wasn't me. I represented him in suing the other lawyer for malpractice, and we won that case, and we got a big chunk of money back. But he still nonetheless lost his home. Now, if he had been incorporated as opposed to working as a sole proprietor, then that judgment would have been against his corporation and not against him personally. So that's the threshold question. Do you have assets to protect? Okay, considering a corporation is appropriate. And then what's the cost of incorporating? It's relatively minor. There are all kinds of services out there that do incorporations for you. You have to be careful though with some of them because, the minimum you have to do to incorporate is file what are called articles of incorporation. And that's a really easy thing. It's a one-page document. But that's not the end of the process. You also have to have what are called bylaws. And the bylaws are kind of the operating system for a corporation, explaining the roles of various corporate officers and other important things about the operation of the corporation. You have to adopt those. And then it also explains how many directors you have. Every corporation needs to have a board of directors. It might just be a single director, but you got to have one. And then you have shareholders. So you've got to distribute shares. And then you have corporate officers. The power structure in a corporation really starts with the shareholders. Shareholders nominate and elect directors. Directors nominate and elect corporate officers. Corporate officers run the business. But all those things need to be done as part of the opening of your corporation. And if you go to an online service and you just get the absolute minimum and they just file articles of incorporation for you, you haven't completed the process. And that could become an issue of significance if, let's say, you're sued, your corporation is sued, and then the party suing you discover that you didn't complete the process, and they take steps to do what is called piercing the corporation. So they would argue that the corporation was essentially invalid and shouldn't be a shield for liability because the initial formation steps were never completed. So, keep that in mind. The other thing is that, and I'll just pitch the idea of using a law firm as opposed to an online service for something like forming a corporation. The forming the corporation is a relatively easy thing, relatively inexpensive, but it's a beginning step. So particularly in construction, once you've got the corp, now you've got to go out and get it licensed by the Contractor State License Board. And then, of course, you want to have contracts that are appropriate for the corporation and the type of construction work you're going to do. Probably a set of contracts. And then you're likely to have employees. And so you're going to need to have, HR materials, handbooks, arbitration agreements, set all of those things up properly. And there are legal issues with a lot of those things. They may be fundamental, but that sort of advice and flushing out the corporation, usually a little bit more than what you're going to get with an online service. The other thing is, the best way to use a law firm, mine or any other, is to develop a relationship. The more we know about our clients, the better we are able to help them avoid legal pitfalls. And that can be the difference between staying in business or not. So just something to think about. Now, another note about limited liability companies or corporations, LLCs, in relationship to the construction business. You can use an LLC. You can get it licensed, but California has an additional requirement for LLCs that is not present for a corporation. An LLC has to have a $100,000 bond that is posted with the state of California for the protection of claimants, particularly employees who may have claims against their LLC, let's say non-payment of wages, things of that nature. So that's an obligation that is not present when you form a corporation. So generally, I do not recommend contractors go with the LLC route because of that significant expense. And it's not just the expense, but when you've got that bond, it's a little bit that may come back and cause you a problem. So you can read more about that in some of the screens here. We've kind of like worked through a few of these issues already, talked about piercing the corporate veil. Let's go on a little bit more. Let's talk about, the difference between, maintaining a corporation once it's formed versus the maintenance for an LLC. It is true that LLCs have fewer obligations in regards to maintenance. You don't have to have a board of directors for an LLC. You don't have to have officers for an LLC. You don't have to have annual minutes and meetings for an LLC. LLCs are a little bit simpler. For corporations, on the other hand, as I mentioned, you've got to adopt a set of bylaws. You have to have a board of directors. You have to have officers. And when the corporation is engaged in activities that are outside of its normal business, you generally need to document that with a corporate resolution. Let's say, you're in the construction business, you're incorporated, and you decide that you want to go out and borrow a significant sum of money so you can buy a bunch of equipment that you're going to use in the business. Well, you want to document that with a corporate resolution. So what is a corporate resolution? It's basically a document that is drafted for approval by the board of directors and the corporate officers that acknowledge the activity and approve the activity as something necessary and ordinary for the business. Now, and that might generally be also referred to as a corporate record. Other corporate records are, your ledger of your shareholders ledger. So some folks kind of forget to carefully document who's getting shares, how many shares, are there restrictions on the shares? All of those things need to be carefully considered and documented. And with corporations, for instance, the state of California requires for corporations that are used in the contracting business that they have a minimum capitalization of $2,500. Well, it's not a whole lot of money, but nonetheless, let's say that you incorporate, you open up your checking account, your corporate checking account, and you decide, I'm just going to put the minimum in there, and you put $100 in there. And then don't get around to putting any more money in the corporation for a while, and you don't document, the fact that the corporation has $2,500 in capital. How would the corporation get capital? By selling shares or by borrowing money. Those are a couple of ways that the corporation can be capitalized. But if you don't have a paper trail evidencing that that was done, and then later, let's say you're involved in a lawsuit, and by the way, when lawsuits happen, what do lawyers do? Well, they gather up all the relevant documentation and they kind of go over it with a fine-tooth comb. So if you're sued as a corporation, the relevant documentation, part of it is going to be all of your corporate records, starting from the very initiation of the corporation, going forward through the life of the corporation up to the present point. So if at the very outset you didn't properly capitalize your business, well, that could be used to argue that the corporate shield, again, shouldn't be allowed to protect your personal assets because you underfunded the corporation. So while California has its minimum $2,500 requirement, that's really is just an absolute minimum. You want to think about the actual financial needs of the corporation when you're considering what capital you need. One rule of thumb is to determine what the estimated expenses of the corporation will be for the first 6 months of its existence and use that. as a benchmark for capitalizing the corporation. So what those expenses might be, your labor expenses, how many employees are you going to have, the cost of doing business. So that number might be rather substantial. But let's say you don't do that. Let's say that you thinly capitalize the corporation. You sign up a nice big fat juicy contract. Things go sideways. You get sued for breach of that contract. The corporation does. And then in the discovery phase of the lawsuit, the attorneys who are suing you find out, gee, you put hardly anything into your corporation to capitalize it. And now basically the corporation has no assets. Well, they might argue that they should have the ability to pierce or to set aside the corporation and achieve a judgment directly against the owners of the corporation. Who are the owners of the corporation? Well, they're shareholders. And a lot of these corporations, by the way, they might be single shareholder owned corporations or husband and wife or one or two people. That, also arguably makes the corporation a little more vulnerable to the argument that it was really set up as a sham. So considering additional shareholders is something that can strengthen your corporation. Also, setting up your board of directors, you want to think about, well, who should be on the board of directors? Just the corporate principals? Yeah, that could be. But if you want to strengthen that corporation, it's going to have members sitting on the board of directors who are beyond just the principal owners of the corporation. Now, there's also a consideration to keep in mind in that regard, because remember, corporate power stems from shareholders who nominate and elect members of the board of directors, and then members of the board of directors nominate and elect officers. Officers run the corporation. So if you have a board of directors and they can outvote you, then you can inadvertently give your members of the board of directors more power than you might have as the person who formed the corporation. Now, if you have a majority of the stockholders in the corporation, you could perhaps change the members of the board of directors. In order to determine, whether you can do that or not, you're going to have to take a look at the bylaws. The bylaws are also going to indicate, what the vote totals have to be in order to make significant changes during the life of the corporation. So let's say, for instance, you got a template set of bylaws, which is kind of common, that you never read them because, they're 10, 20 pages long, and then a dispute happens and you decide, well, I want to take action and replace one of my board of directors, one of the members of the board. Now somebody says, oh, let's look at the bylaws, and you discover that it takes a vote of 2/3 of the actual shareholders to make a change. And you don't have 2/3 anymore because you've brought in other shareholders. Maybe you've got a majority, but you don't have 2/3. Well, that's something you want to discover or know about, right at the outset before you adopt the bylaws. So when you're back to kind of like, putting some careful thought into the formation of your corporation, what do those bylaws say? Because before you adopt them, you might want to edit those template documents, to make sure that you don't inadvertently give up control of your corporation. Which, something else we should really talk about is, what is control? What generally evidences the ability to, make significant decisions like changing out members of the board or changing out corporate officers. Generally speaking, in most sets of bylaws, 50+%, makes all those significant decisions. So, if that's true with your bylaws, you could sell interest, share interest in your corporations up to 49%, raise revenue that way, and not lose the ability to control, the destination or the destiny of the corporation. So something to keep in mind. Now, there's also something with shareholders that is additionally significant, which is, when you sell shares, you want those shares to be restricted in the sense that, you don't want to end up doing business with strangers. So let's say you sell shares to a close associate, and that associate decides later to sell the shares to a competitor of yours. Well, you wouldn't want that. But unless those shares have restrictions on them, which tie back to what we call a buy-sell agreement, something of that nature could happen. So what's a buy-sell agreement? A buy-sell agreement is essentially an agreement that says before a shareholder can sell shares to a third party, they have to get an offer from a third party and then share that offer with the corporation itself, give the corporation an opportunity to buy at the same price. And if the corporation passes, the other shareholders have an opportunity to buy at the same price. If neither the corporation or the other shareholders want to buy, then the shareholder is free to sell to that third party. That's called a buy-sell agreement. That's something that I think is critically important in the formation of a corporation. You ought to have something like that. So now you've got all those fundamental things done, and you've got your corporate book, which is usually something that you purchase when the corporation is formed. That corporate book is where you keep your record of shareholders. You have the nice share documents in the corporation's record book. You have the bylaws, and you keep all of your corporate resolutions there, and a record of all of your elections, etc. And it's a nice binder. You stick it up on the shelf after you do all this stuff, and then you never think about it again. And then 4 years down the line, let's say you get audited by the IRS. Well, guess what? The IRS probably wants to take a look at your corporation. So now you might be a little frantic because somebody might have explained to you at this point that, gee, you should have been conducting annual meetings and keeping a set of annual meeting minutes for your corporation. And you didn't do any of that stuff. And now the IRS wants to see all of your corporate records. Well, if you don't have that and you can't correct for not having that, and the IRS takes a look at your corporate book of records, it could also potentially decide that the corporation wasn't legitimately formed or maintained, and then set it aside and look to the principals for whatever tax liabilities may exist. So it's not just litigation that might prompt you or be a concern to properly maintain your corporation, but it's also something like an IRS audit. So what are corporate minutes? It's also pretty much a template document for the most part. Wanting to create a record as to any changes in, let's say, officers during the course of the year. Were there any significant business developments? So it's the board of directors, and sometimes also the shareholders having a meeting and going over what did happen in the last year and what they expect to happen in the year going forward. and maintaining those records in the corporate book. So not a big deal, but it has to be done every year. Corporations have to have at least one annual meeting. So that's easy. Okay. Now, contractor requirements, we've already kind of touched on this. So I think we can skip to the next screen here. Maintain updated operating agreement. This is specifically for LLCs, which the requirements are similar but a little less onerous. In LLCs, you have membership interest rather than, it says membership shares, but it should really say membership interest. Shares are a reference to corporations. LLCs have membership. Kind of the same concept, however. Let's talk a little bit about the tax implications of having a corporation versus an LLC and what's called a C Corp versus an S Corp. So I think that there's a course that accountants take early in their careers where the pitch in that course is how to double your business without really trying. And the idea in that course, and I'm just imagining this, I've never seen evidence of it, but I can imagine, the course being a recommendation that accountants ask or recommend or strongly recommend to their business clients that they should incorporate. Well, why would accountants be interested in that? Well, because that creates a new taxpayer. The law views corporations as separate legal entities. So in addition to your personal tax returns, when you incorporate, you have to file a corporate tax return. So that's double work for the accountant. There's also going to be a minimum tax in the state of California, whether you make money or not. Corporations have to pay the state $800. So there's a little revenue that comes off the top that goes to the state. Now, when you set up your corp, you have an opportunity to make a selection as to, or an election, either term will work, as to whether or not you want the corporation to be what's called a C Corp or an S Corp. And the difference essentially is that an S Corp treats the corporation more like a partnership than a corporation, in that the losses or profits of a corporation are going to pass through to the shareholders in proportion to the shares they hold in the entity, and then be reported on the shareholders' personal tax returns. One of the benefits of doing it this way and having an S Corp, and by the way, this is something that you should talk to your tax professional about, but one of the benefits is the avoidance of what's called double taxation. And double taxation would work this way. Let's say you've had a really good year and you're not set up as an S Corp, you're a C Corp. So you have a really good year and the corporation is showing a substantial profit. Well, the corporation is going to pay taxes on that profit. And let's say that the corporation is also going to issue dividends to shareholders as one of the ways that they're going to distribute that profit. Well, when you get dividends from your corporation, guess what? That's income to you. You're going to pay taxes on those dividends. So that's double taxation. The corporation pays it once, and then when the corporation issues dividends to you, you're going to pay a tax. So that's a C Corp. Now, if you're set up as a C Corp, what generally is the goal is to zero out the corporation's profits at the end of the year, so that you don't have a double tax situation. And, how do you do that? Well, you do some forecasting. And if you've had a good year, maybe before you get to the end of the year and wrap up the books, You decide, well, it's a good time to go out and buy that equipment that we wanted, or we're going to issue employee bonuses or something of that nature. But it's sometimes the case where you show a lot of earnings on the books, but you don't really have the cash. So, that can be more difficult than it might sound to kind of zero out your profits at the end of the year. But if you have an S Corp, where profits or losses are going to pass through to shareholders in proportion to their ownership interest in the corporation, you avoid that problem. So you get to the end of the year, the corporation has a profit. There's going to be something called a K1, which is the accounting tax document that indicates what percentage of the corporation's profits or losses are going to be passed through to the individual shareholders of the corporation. So have that conversation with your accountant as to what they recommend in regards to setting up a corporation, whether it should be a C Corp or an S Corp. Let's see what else we got here. I think we've pretty much covered this stuff. I'll emphasize again the importance of maintaining those stock transfer ledgers. So when you get typically you form a corporation and you, as part of it, you buy a corporate record book, which is going to have, a stock ledger. It makes it really easy for you to keep track of, who was issued stock, what was paid for the stock. So down the line, let's say, somebody wants to, sell that stock back to the corporation, there's at least a record of what that initial purchase was. So, keeping those records, maintaining those records is important. So getting the corporate kit when you form your corporation, a step you shouldn't skip. I recommend you do that. Okay, there are some, formal requirements, state filing requirements for both limited liability companies and for corporations. Your attorney is going to help you with that. Both documents require regular information to be provided to the state of California regarding, the principal location of the entity, the directors of the entity, sometimes the officers of the entity. So those reporting requirements are something that you need to check out. And of course, as we mentioned, if you're a licensed contractor and you want to use your corporation for construction, then you have to get a separate contractor's license number from the Contractor State License Board for your corporation. You do that by, having somebody who already has a license act as a qualifier. And it's pretty much a paperwork process with the state of California, but your qualifier needs to apply to qualify the corporation for a license. Same is true for an LLC, by the way. And after submitting the application and paying the fees and getting an appropriate bond, the state of California issues a contractor's license in the name of the corporation. And it is possible, if you're an individual and you have an old license number, you may choose, for marketing purposes, let's say, to have your personal license transferred to the corporation. That's something that you can do. If you think having that older number is something you want to pass on to your corporation. But the jeopardy of not doing this, not ensuring that your corporation is properly licensed at all times during its performance of any construction work, is that you'd be violating civil laws and criminal laws by contracting without a license. Now, a lot of people think, well, gosh, I have my personal license and I'm the president of the corporation. And maybe I even own all the stock of the corporation. So why does my corporation have to have a separate license? Well, it's kind of like yours is not to wonder why. It's just to know the rules and play by the rules. The answer is because the state of California says so. So if you skip that step and you incorporate because let's say your accountant said, hey, good idea, why don't you incorporate? And I've seen this often. The accountants are excited about picking up this new taxpayer, so they do the corporation for their client. But the accountants, generally, they're not lawyers, and so they may completely skip the step of making sure that the new corporation has a contractor's license number. And then you're off, doing business thinking that everything is just fine. And you get into a little legal spat. Let's say you complete a job, you do everything wonderfully well, but at the end of the day, you don't get paid a significant sum of money. And so you decide to file a lawsuit. Well, when you file a lawsuit as a contractor, one of the things you have to prove right up front is that you are properly licensed at all times during the performance of the work. So if you're a corporation, the contract would have been with the corporation. The corporation is going to be the suing party. And if you can't prove that licensing part, well, first off, you lose because unlicensed contractors cannot enforce payment for their work. Secondly, it'll get turned around on you because the parties you contracted with will now have the right to sue for something called disgorgement. And disgorgement is the legal term for you got to pay all the money back. So everything that you were paid as an unlicensed contractor, let's say an unlicensed corporate contractor, although this would apply to you as an individual or a partnership as well. But if your corporation wasn't licensed, let's say on that same project where you, at the end of the job that you did beautifully, and you're suing to get that last payment, and then you find out to your chagrin that you skipped a step and you didn't incorporate or didn't license your corporation, now you're playing defense and the other side is suing you to get all of the money back they paid you. So maybe that was a big chunk of money. And you say, well, wait a minute, an awful lot of that money went to pay for materials. Doesn't matter. You say, well, wait a minute, most of that money went to pay my employees. Doesn't matter. Well, how about all the money I paid to my licensed subcontractors? Does not matter. If your corporation wasn't licensed, the two things that matter is you're not going to be able to get paid for the remaining balance, and you're going to be liable to have to return or refund 100% of the money you collected while contracting without a license. So that's a biggie. And you might think that that doesn't happen very often, but actually it does. People make sometimes unforced errors, let's say, with their licensing, whether corporate licensing or individual licensing. Another way that you could inadvertently lose your license and be subject to that same disgorgement remedy is that you allow your contractor's license bond to lapse. You don't pay the annual fee, and the bonding company notifies the CSLB, the California Contractor State License Board, that you now let your bond lapse, and the board suspends your license. Generally, there's going to be notifications to you about all of that. But if you're running fast and loose and you don't pay attention to that stuff, you could inadvertently lose your license and then find yourself in this situation where you're facing this significant jeopardy. The other way that disgorgement comes up, where you may be unaware of it, is the failure to have and or maintain workers' compensation insurance for all of your employees. Now, on the face of it, that doesn't seem like a real difficult thing. But in reality, I've seen several situations where contractors cut corners there. So maybe when they report their payroll to their work comp carrier, it's inaccurate. Maybe they paid some of their folks under the table for, overtime, let's say. And so they're not fully reporting their wages or wages they should have paid to the work comp carrier, who calculates their premium based upon wages. And if that's discovered, then your license can be retroactively suspended back to the point where you cheated. And if it's suspended, retroactively, then that means you were contracting without a license. And that means you're going to be subject to disgorgement. Another way that happens is if you hire unlicensed subcontractors. And the unlicensed subcontractors are performing work, and maybe they have employees. Well, in California, when you hire unlicensed subcontractors, all those folks become your employees. And if they're your employees, what do you have to have for them? You have to have workers' comp. So if you don't know that, and your work comp carrier doesn't pick it up, that's also another way where you can be subjected to disgorgement. So something to be very careful about. So that's some of the do's and don'ts about incorporating. Here's some additional reference information if you want to follow up a little more on this. And of course, you can always submit questions to me, send me an email. Much better to send me an email than to give me a phone call because, phone calls, we might be playing phone tag back and forth. But if you shoot me an email with a question, I'll get back to you. So good luck. Go out there, be safe, make some money. See you next time.